Today, investing in uncertain times. Hello again, it's Martin North from Digital Finance Analytics, web latest post covering finance and property news with a distinctively Australian flavour. Today I'm joined by Sam Kerr from Nucleus Wealth. Hi Sam.
Hi Martin, how you going?
Yeah, pretty good. You?
Yeah, very good, thanks.
Great to have you on the show, and you've joined the Nucleus Wealth crew, focusing on some of the advice-related areas. But one of the interesting questions that I keep getting, and I think you may do too, is, gee, these markets look pretty shaky. We've already seen the Nasdaq down more than 10% now, so that's an official correction. The others looking weaker too. And so the question is, in such uncertainty, how should we be thinking about investing? And in fact, should we just go away and wait to see what happens? So I want to have a conversation today about how you think about investing in such uncertain terms.
Yeah, I think it's a very on-point topic. The client conversations I'm having at the moment, there's lots of people that are uncertain about the future. I think there's a lot of fear out there. Fear around the future, fear of COVID, potential health impacts. And so, yeah, I think if you look to the past, the past and life has been inherently uncertain.
What do you mean you can't predict the future? Get your crystal ball out and give it a polish.
Yeah, well, that's the thing. No one knows what the future holds. And, is now any different to the past? You've got to sort of ask that question. And I think, what we can cover today is how to sort of mitigate that uncertainty in the investment world as well.
And look, it is worth just reflecting. Clearly, things are uncertain at the moment. We've got the current COVID cycle, and of course, WA overnight announced that they were going to not reopen as planned. We've got high infection rates in some of the other states. We've got a lot of informal lockdowns currently running. And whilst the unemployment number was very low yesterday, surprisingly low actually, expectations are it's probably going to be higher ahead. Internationally, of course, the Federal Reserve is suddenly getting nervous about inflation and now signalling that they're going to have to do something quicker. And so the markets are now basically saying, interest rates are going to be higher quicker, particularly in the US. And because of what is happening over there and because of what happened with the employment number yesterday, now people here, even like Westpac, are saying, well, maybe rates will go up high here. So, there is a set of clear signals about uncertainty. And I suppose the other point is that, if you look at the markets are actually pretty high still at the moment, relative to price earnings ratios and relative to other measures. So you'd have to say there is more chance of them going sideways or down than going up dramatically, bearing in mind the reason they went up was all the quantitative easing and all of the money printing and all of the low interest rate stuff, which is now slowly being unscrambled. So, people I think probably are right to be aware of the fact that it's pretty uncertain times at the moment.
Yeah, absolutely. And I think there's so much liquidity in the system. That money's got to find a home somewhere, and it generally finds its way into property and stocks and other asset classes, but mainly sort of growth assets there. And the markets are stretched, valuations are high, so maybe uncertainty, maybe that fear that people are experiencing is justified to a degree.
So then the question is, right, if you're already in the market, right, should you actually then say, well, is it time to sort of bail out before things get worse, right? And if you aren't in the market and thinking of going into the market, right, is now a time to sort of just wait and see what happens, or should you actually still be thinking about, well, the market may present some opportunities even through this down cycle volatility?
Yeah, well, I think what we need to sort of make a distinction around is whether you're an investor or a speculator. An investor or a speculator their time horizons are generally short, so they have a lot more risk in the short term because, as we know, anything can happen in the short term, and markets are inherently unpredictable in the short term or inherently volatile. So speculators they have a lot more risk because the markets can go up, they can go down, but whereas an investor, they're with a longer term focus. If they align themselves with the growth assets, the shares and property, over time, they generally have less risk because over time you receive the accumulation of dividends, you can pay down debt, and over time those higher expected returns tend to show up. Whereas the short term, anything can happen, but over that longer sort of time period. So it depends on your time horizons, what sort of market participant you are, and whether you're in it for the long term or whether you're just trying to make a quick buck on the playing the volatility.
Right, but it isn't necessarily a 0 or 100% game, right? So if you think about building wealth over the medium to long term, you probably want to have a core holding, which is more an investment style of holding. In other words, you're looking for long-term growth. Sure, it might go up, might go down through the cycles, but over time, with the interest on interest, the cumulative effect of inflation means that there should be some long-term positivity there. But you might also choose around the edge to, speculate a little and play a little and, maybe trade a little. But it's important not to mix the two because they are fundamentally different, aren't they, in terms of strategy, intent, and outcomes?
Yeah, that's right. And I think if we look to history, there's always the disclaimer in the investment world: past performance is not a good indicator of future performance. But if we do look at, say, the past 100 years, there's been we've had it all. There's been wars, there's been famines, there's been booms, there's been busts, and over that longer time period, markets do tend to go on to make all-time new highs. And so I don't see how now is going to be any different, because the stock market, for example, it's ultimately a reflection of human endeavor. And human nature hasn't changed, and people are still going to innovate and create new products and bring them to market and effectively make our lives better. So if you're a long-term investor, I think you just need to stay invested. And, like you say, if you want to do a bit of speculation on the side from that, that's absolutely fine. But like you mentioned, if you understand compounding, understand compound interest, you're sort of seeking those higher expected returns over the long term, you just have to embrace that volatility, embrace that uncertainty. And if markets fall in the short term, so be it. Maybe that's a buying opportunity, but we would expect over the longer term, over time, for markets to bounce back like they always have, and to go on to make all-time new highs.
And it's interesting because, of course, what tends to happen is that when markets start to fall, it's a bit like lemmings, right? Everybody runs for the exits at the same time. If you look back to March, not last year, but the year before last, when we had that very considerable fall, a lot of people bailed out and then were out of the market, and of course didn't have to go back in when the prices were lower, so they missed out. And in fact, we saw quite a few people with superannuation money, they pulled it out, because they were worried it was going to fall even further. But effectively, they ended up out of position. So generally, I think the big "don't panic" sticker, is a really important thing here, right? If you are an investor and you are really taking a 5, 10, 15, 20, 25 year view, right? Then don't panic when these up or down cycles wobble through, because the chances are that trying to pick when to come in or when to go out is probably not going to work. Most people just can't do that. Now, if you're a trader and you want to trade volatility, again, very different, and people did that, and some won and some didn't win. I'd make the point with trading volatility, for every trade that you win, somebody else loses, and vice versa. And in fact, the long-term evidence is it is really quite hard to outguess the market when everybody else is also trying to do the same. So I'm a bit skeptical personally of those people who claim to be able to predict precisely what's going to happen and then trade the volatility appropriately. And if you are just playing the odds, you're playing the odds, right? So those are sorts of two things to think about, right? If you're an investor, don't panic, and if you're trading, then bear in mind that you could win or could lose. But if you are somebody who wants to continue to invest in the market through the cycle, right, which is probably the best advice in terms of long term, what's the strategy to do? I mean, do you put money in, every month or whatever, just wherever it is, and average up, average down, or do you try and pick it? I mean, what's the thought there in terms of how to deal with that?
Yeah, I just want to address one thing first. So you said if the markets fall, you only really lose if you actually sell. And you said when COVID happened, people got spooked, they sold, they were fearful that it was going to fall further. And then the same thing happened during the GFC. Lots of people, they sold out, they crystallized the loss. Whereas if you are that long-term investor, you do have those long-term horizons, this volatility, it's to be expected. And you just have to ride that out, and over time you will benefit from being aligned with those growth assets. So that's just one point I want to make first. And the other thing you mentioned, you've really got sort of two options, I think. You can if you've got capital to invest now, and you're an investor, you can put a lump sum in and just embrace the volatility. If the markets go down in the short term, that's okay. I think time in the market rather than time in the market is a better strategy, and history's sort of shown that, and it is very difficult to actually time the market, like you say. And then the other option is dollar cost averaging. So say you've got $120,000 now, just for ease of example, and you're uncertain about putting all the money in at the moment. You can just invest $10,000 a month for the next 1 year, and then drip feed that into the market each month. Or you could invest $5,000 every month over the next 2 years. So that's a way to sort of, still invest for the longer term, but if you're concerned about that short-term pullback, that can sort of mitigate that risk. And then if you're dollar cost averaging, if markets do fall, then you can sort of dump the rest of the capital in and try sort of time that rebound up. And yeah, interestingly, Vanguard, they did a study on this. And what it shows is that about 2/3 of the time, you're better off actually just dumping the money in all in one go. So yeah, I mean, more often than not, that strategy is going to work for you. And I think the reason for that is you've got more time in the market. And if there are pullbacks, they tend to recover. It's just a matter of how long. For example, you mentioned during COVID, markets fell considerably within a couple of months, fell sort of 30-odd%, and then talking about the Aussie market and the US, and then they recovered and rebounded and went on to make all-time new highs in less than a year, whereas GFC took a bit longer, around about the 5-year mark, to regain and go to all new highs. So yeah, you've got those sort of two strategies. It just depends on how comfortable you are with volatility and whether you can sort of psychologically handle it. And that's one other thing I sort of want to touch on is the psychological aspect of investing, behavioral finance. And often people know what to do, but it's actually whether they can sort of make that connection of actually getting themselves to do what they know they should do. Yeah, that's just it's not all just sort of cause and effect. There's other things going on there with the psychological aspect.
And that's a very important point, right? Because actually, I'm not sure sometimes going and looking at the index every day or looking at your stock price every day is necessarily good for your health, because basically things do move, right? They will go up, they will go down, right? And if you are in the market over, a 5 or 10 or 15 or 20 year time horizon, in a way, those short-term gyrations up and down are not necessarily helpful in terms of understanding, what it really is going on. I think it's also important to make the point, though, that where you invest and which fund you invest in is also pretty important, because not all funds are the same. There are some funds where they perhaps are more aggressive. Growth funds perhaps sometimes are looking for the upside, and then there is a greater risk on the downside. There are other funds where effectively you're always playing the counter argument and say, well, what if it goes this way, right? And like some of the Nucleus Wealth funds, you do play almost both sides of the fence. You think about the growth, but you also think about the what if it goes in the other direction. So it does actually make a difference as to where you invest as well as investing.
Yeah, that's right. And I think a really important point as well is to have a plan and to stick to a plan, because we know we should just invest for the longer term. But when you're looking at the market day to day, week to week, month to month, in that short term, it is easy to get sort of caught up in the all the news headlines and the doom and gloom often, and the fear. Whereas, if you've got a plan and you say, right, I'm just going to regularly, focus on what I can control, and that's regular contributions and your asset allocation, controlling your risks through asset allocation, but regular contributions. For example, if you say, right, I'm going to invest X amount every 3 months, going forward into the future, to take advantage of that compound interest, you just have to stick to the plan, and that can really take out a lot of that sort of psychological aspect of the fear and the uncertainty, and help you focus on the big picture and the longer term.
Well, you mentioned a plan, right? And I think that's really one of the things that I quite often find when I chat with people is that they don't really have a very strong plan, right? They sort of make it up as they go along, and sometimes that works. Also, they can be over-influenced by, the YouTubes and the stuff in the press, et cetera, and again, sometimes some of the stuff that's out there is actually coming from a particular viewpoint, perhaps trying to flog a particular product or whatever. So it is quite important, if you are going to start getting, information, to think where that information came from, and how objective is the information that's being presented. But it is interesting to me that a lot of people end up with not a very good plan, and quite often what it ends up with is don't do enough earlier. When people are younger, it all sort of gets compressed, and suddenly they realise that they're beginning now to move towards, the last phase of their working life, and suddenly the retirement issue comes up, and, well, have I got enough for retirement? It's almost like, well, if you'd only planned 20 years earlier, right, you could have actually had a much, much cleaner ride through. So the need for a plan, I think, is a really important takeaway from this conversation.
Yeah, agreed. And when you understand that time in the market is your friend, time when it comes to compounding, that's really, really more important than anything else, because of that compounding over the longer term. Like you say, if you get a plan early and you can just stick to it and regularly save and invest and compound your money over time, then there's not that sort of panic when people start to get to the end of their working life and think, oh gosh, I haven't got enough set aside, and then that sort of a bit of panic sets in, and they're trying to do it all when if they just had a regular plan and just regularly saved and invested, they'd be much better off over the longer term.
And of course, the point there is if you actually start then to see, a bigger problem looming, with less years to go, you then are forced to take higher risk investment options. And of course, by definition, higher risk, well, it may pay you a higher return, it may not. And of course, what I often say to people is, if you see these high levels of return, you got to understand that there's a higher level of risk attached to them. So it is important not to jump into those high risk strategies. Even Philip Lowe the other week was again saying, well, people are being forced to go into higher risk, investment classes because of the fact that you don't get much on term deposit now, et cetera, et cetera. So again, it's really important to understand some of these fundamentals when you build your plan. So time in the market, lay the foundations, stick to your plan. And don't panic when you start seeing these market durations, because in fact, a lot of people out there in investor land, it seems to me, spook themselves, right? And sometimes just a level head is the right approach.
Yeah, and I think part of the reason for this uncertainty is because of some of these macroeconomic factors like the low interest rates. And people being forced to sort of take on more risk because they're not getting, they're getting sort of negative real returns with cash in the bank, and similar with bonds with such low yields that they're sort of being forced into these riskier asset classes to try generate sort of returns, and sort of forced to take more risk. But like you sort of mentioned before, not all asset classes do have different sort of risk profiles associated with them. And if you're with the growth assets, stocks and property, so for example, Aussie shares, that's got sort of a different risk sort of profile than US shares. And what I mean by that is in terms of if there's market downturns, Aussie shares are a well-diversified portfolio of Australian shares. They generally pay higher dividends. And, say if you're getting an 8% return on average over the longer term from Aussie shares, like to be conservative in these numbers, and say you're getting 4% per year in the form of a dividend, and then 4% capital growth, that dividend, the dividends tend to be much more stable than the capital values. And those dividends can actually insulate you to a degree from market downturns. So, say markets fell by 20% and they stayed low for the next sort of 5 years, instead of, you would sort of be around break even because of the fact of the dividends. And, if you're reinvesting them and compounding them, you'd actually, through the accumulation, you'd actually be better off. Whereas other growth assets that are more just capital value based, that don't really produce much income, you're totally reliant on one aspect of the return there, in terms of you're just focusing on the capital growth rather than having that dividend to sort of support you and insulate you a bit from market downturns.
Absolutely. Yeah, well, it's been a very interesting conversation. I think we should just at this point caveat by saying this isn't financial advice in any way. This is just a general conversation about the markets. But if you want more specific advice about what's going on, Nucleus Wealth or the Wealth Fund, which is powered by Nucleus Wealth, is a good source of information. There's a lot of stuff there. And of course, there's an opportunity potentially to have a more specific conversation with you guys in terms of some of the products and services that you offer. But generally, the message I think for today is there's no need to panic. Have a plan, stick to the plan, and understand the difference between speculative and long-term investing. And if you're in the long-term investing where your core portfolio of growth should be, Nucleus Wealth is and what the World Funds is a good place to think about.
That's right. I think you've summed it up perfectly, Martin. You've hit the nail on the head. So,
great. Yeah. Well, I try to do that. Good. Enjoyed speaking with you, and I'm sure we'll do it again soon. Take care.
Thanks, Martin. Cheers. Bye.
Bye.